Hey guys, and welcome to another video. Today I want to make a video about a stock you should look into buying because it's a really nice company and it's pretty cheap. So how much could you expect to make every year with this stock? Around 15%, which makes a 4 times return in 10 years because you will get 15% on the gains you make every year too. Which stock am I talking about? PayPal. I think every one of you knows PayPal, but to summarize, they are a company providing payment services to its customers. Now you can see the chart of PayPal in the background, and depending on your knowledge of stocks you may say PayPal has gone down, why should I buy it then? It has gone down, which you could say makes it cheap, and it can go up, but you should mainly look at the financials. Well, I haven't done a video about financials yet, and this video won't really cover it that specifically, but you can go do some research on the numbers I'll show you, and I'll try to explain them briefly too. I will also show you some tools I use to calculate how much a stock can make you in 10 years, which is the time you should stay invested in PayPal and other value companies. If you want to invest and not trade, but you can also do both. In this video I will only talk about an investment in PayPal, so let's start. First of all, we'll do an evaluation with two different models. The one I mainly use is this one, an Excel program I have written myself, and the second one is a cash flow model which I have taken from this YouTube channel, Investing with Tom. And you can download it. The video's name is How to Calculate Intrinsic Value Updated Stock Market Investing from the 31st of July 2023, and you can download it in the description of the video. This channel is also a nice channel for looking at investing and getting some knowledge with which other channels don't provide. And the other model I will upload, I will put the link up soon, but I can't right now because my YouTube channel isn't authenticated yet, so I can't put links in the description. But let's start. I will show you also how the model works. So first you put in the name of the company, PYPL, the ticker symbol. Okay, then it will show you the price and 52-week high and so on, and the shares will be updated automatically, and the price to earnings right now is 17, and the market capitalization is $68 billion. So what do you do now? First, in this model you will have to take the revenue growth. Revenue is the money a company makes every year. Let's say you buy an iPhone, the price you pay for that iPhone goes to Apple, and it's the revenue Apple makes from that iPhone. So the revenue of PayPal was $27 billion last year. So let's put that number in. 27. And how much will it grow? Let's look. It more than doubles in the last 7 years or something like that, but we won't put in that big of numbers. So you can also look at Yahoo Finance to see what some other investors think PayPal will grow like. They say, for example, it will grow at 15%, which is a bit high if you ask me, but we will use the second number for the second model. In this case we will put in, let's say, 28 goes to 43, seems more reasonable. Profit margin, okay. For profit margin you will go to statistics, and you will look at the net margin, which is the price, which is the amount of earnings a company makes divided through the revenue. So let's say, so what is earnings? Earnings is the money a company makes after you deduct expenses and costs of service and taxes. So let's say you pay $1,000 for your iPhone. Apple has, let's say Apple has spent $500 for making your iPhone and $100 for advertisement, for example. So it makes so it has spent a total of $600, so it has earnings of $400. Let's deduct taxes of, let's make it simple, 50%, which is really high, but that would make earnings of $200, and you would have made $200 earnings after taxes divided through revenue of $1,000 makes a margin of 20%. 200 divided through 1000. So that's the net margin. So you take an average of the net margins you see here. Let's say 12 is very low, so let's put in 12 for our low assumptions, 12%. And price to earnings, you can look at the price to earnings ratio. What is price to earnings? Price to earnings describes how overvalued a company is. It's the price you pay for a company. Let's say Apple costs 10,000 euro. Let's say Apple costs what can we say, 2,000 euros, and and makes 200 euros earnings. So the price to earnings would be 2,000 divided through 200 makes 10 times price to earnings. So every year Apple makes 200 euros earnings, and after 10 years you will have made your investment back if you couldn't sell the stock. That's price to earnings simplified. So let's look at price to earnings. I wouldn't go above 25 is really high for a company, because it has 50 price to earnings, but if you really want to invest safely, I would recommend not to go higher than 20 to 25 price to earnings. In this case, let's take around 17 is really a good price for a company that big of a size. Then Gewinn is the amount of money you want to make every year. In this case, we want 15%. And what are these numbers? So the number of shares is added automatically. So here we can see the revenue, which grows every year by 5%. You can look at the formula right here. It grows to $43 billion after 10 years. Then you have the earnings, which is at the start $3 billion and grows to $5 billion. And the earnings per share is just how much earnings you get per share at a share price of $62. It's you get $3 of earnings in the first year, which makes a price, if you calculate 3 times 17, you will get 62, or around 62. So with these assumptions, which are really low, it would be a buy price for PayPal would be $23. But let's put in some more reasonable assumptions. Let's look again. Okay, price to earnings, we had 17. We can put in like 20, I would say. Let's put in 20 price to earnings, which is still lower than almost all the years, all of the data which is shown here. It's only once under 20 price to earnings, which you can see here. And we will put a net margin or profit margin of let's say 13, maybe. Yeah, let's put 13. And we had 12 before. Okay, that won't make that much of a difference. 13, and let's grow our revenue by 7% every year, which lets it go up to 53 billion. Now you have a buy price of $35, and these are, but you will still make a profit. You will still make a profit in this case, but not as much profit. Now let's put in some reasonable to high assumptions, which will get us to our 15% per year target. So these are more higher assumptions, but they can still be seen as reasonable. We have revenue growth of 9%, which makes $27 billion of revenue go up to 63, which is a bit more than double, which is still reasonable because it grew really much in the last 5 years. You could say it can double in the next 10 years. And we have a profit margin of 16, which is a bit higher than most of the years, but with more time, almost all the time the margins grow and the net margin grows, and in a high case to middle case you would have a profit margin of around 15 to 17. And the price to earnings of 25 is a bit high. You could say 20 is a better price, but it's a good investment for that price with this model. And I haven't even calculated dividends or share buybacks, which I can also show you in another video, but you don't need that. I would say this calculation you should put in your own assumptions. Let's say 25. 20 is a better price to earnings. How much will this grow? How much can you expect? 13% I think is reasonable. Yes, 13%. So with 20 price to earnings and these assumptions you will get 13% per year. So let's take our other model. In this case we also put in the price. By the way, if you use the model of the video, you will need to probably do need to adjust this box. You will need to go to data and then to this arrow and select stocks, which is this one. Now here the shares outstanding is not automatically implemented, so you have to take this number too. But if you want to add the shares automatically, you can use this formula. In English in this case, okay. Now let's take the assumptions of Yahoo Finance with growth of 15%, which is really high, but let's take them. 15% growth rate. And let's do half of that in the next 5 years. So in the first 5 years, 15%, after that 7%, which is half of that, a bit less. Then discount rate is the amount of money you want to make every year, the gain you want to make. Terminal value is price to earnings. We will make 15 in this case, but don't go higher than 15 in this example. 10 to 15, 10 for a bad company, 15 for a good company, like this YouTuber also told in his video. Year 0 free cash flow, we will take 5.1 billion. Let's put it in another format, 5,000. And stock-based compensation, you can look at Yahoo Finance, go to financials, then cash flow, and then it's stock-based compensation, which is 1.2 billion. And we will put that in as 1,200. Net cash, net debt, you can look at TradingView, go to balance sheet and go to net debt is 600 million. So you put in, and don't forget the minus 600. Okay, and number of shares outstanding, you go to TradingView, go down to diluted shares outstanding, or pick the higher number of them, 1.16 billion. So you put in 116 thousand. Okay, so what values will you get? What does this model do? It calculates the cash flow less stock-based compensation, so 5,000 cash flow minus 5 billion minus 1.2 billion makes 3 billion, makes 4.3 billion, and then it calculates the present value by deducting 15%, which you want to make every year, and you will get and then it will grow at, in this case, 15% for the first 5 years, and after that grow 7% every year, and then it will then it will have the cash flow after 10 years, which would be in this case $10 billion. And 10 billion times the price to earnings or price to free cash flow of 15 would make 160 billion valuation of the company, and the present value would be 39 billion. And then you calculate the value of the shares, which is around $63 in this case. So with a price of $63, you have a margin of safety of 2%, and you make 15% every year. But I prefer to look at both of these valuations. I mainly use my own valuation for stock investments, even though I've used the cash flow valuation a bit more, but I don't fully think it's representative of the returns you will get. So use this. So be sure to know what you're doing with by using this by using this valuation model. And here you can see you would have 20% margin of safety with a price of $50 and so on. So what do you do now? Now you have to look at the financials of PayPal. So you go to the earnings release of PayPal on their website, and you read through it and think about if these numbers make sense to you, and then you think about if the company can grow its revenue and its earnings like we calculated before. Then you go to Google and look at stock bull and bear cases, which means what could happen, what could be bad, what you couldn't have thought about before buying, and what is nice looking at the company. So in this case, it has some rivals, which could be bad for the company, and there are some more bull and bear cases you can look at before investing. So please do some research before you invest, and pick a price you want to invest in. And you could also dollar cost average, but I don't really recommend that. But if you didn't understand the numbers and you still want to start investing in a company, PayPal is nice, and you could start investing a small amount, like 1% or less every quarter of the year or something like that, or every month. But keep in mind, don't invest more than 10% of your money in one company, or better do around 7% or less, depending on your knowledge of stocks. In this case, why did I buy PayPal? Yes, I bought PayPal around here at $63 to $62, and I have recently, as it has fallen, even though it has made some nice earnings, I have bought some more shares. So if you like this video, please give it a like, and bye.